The broadcast is now starting. All attendees are in listen-only mode.
Hey, good morning or good day, depending on where you're at. My name is Rob. I'll be kicking off the webinar this morning. And before we do, could somebody give me a sound check? Just put Y in the question box. Let me know that you can hear me okay. Very good. Thank you, Randy. You're always quick on the draw there. So want to just kind of lay some groundwork here for the webinar this morning. The first thing I want to do is let everybody know, particularly since we're having so many new people on the webinar with us each week, that this webinar is designed to have Wade and Shane go over different pairs. So by the way, if you have a pair that you would like to have looked at, make sure that you write that in the question box and do that sooner than later, so that way Wade can be writing those down and taking note of them while Shane's doing the volatility report. The other thing that, and make sure that you give us a entry time frame and then whatever supporting time frame you're looking at as well. So that way we know exactly what to review. The other thing I want to mention is that this is a webinar that we use to go over trades and or pairs and trading opportunities. So if you have a technical question about the software or something like that, please make sure that you send those to support@tradeats.com. Again, support@tradeats.com for any technical software type of questions. As well as I will say, if your question doesn't get answered in the webinar here this morning, you can always send that over to support@tradeats as well and get some feedback there. So with that being said, why don't we go ahead? Shane's going to be doing the volatility report. So Shane, why don't you take it away?
All right, thank you. So, yeah, like he said, we are going to be going through the volatility report. The first pair that was noted on the volatility report was Pound Aussie, and we had touched on this pair, I believe it was last week or maybe even the week before, that it was finally slowing down. And we finally got our first box on the daily chart that we've had in quite some time. I mean, it's been just running down for a while. So we got it April of this year was our last daily box. So now all that means for us right now is that we've got kind of a new zero line, some new architecture to start basing some trades off of. So a box on the daily means a range on the hour and 4 hour. So we'll start getting more lines and we can kind of figure out exactly what's going on with Pound Aussie. And you know, we're getting a reaction to the weekly expansion line, a previous weekly expansion line. So we know that when we hit that, the market can either reverse off of it or kick back and forth, breathe, and then start heading down short. So anyways, we want to keep our eyes on that. No definite directional bias on it for the moment, but you know, it's something worth watching just because it's finally having a change and it's proven that it's got pretty solid volume. All right, the next pair is CAD yen, so we'll go ahead, not spend too much time on that one. All right, so CAD yen made the report because we are starting up a new master pattern. Those of you that were on last week kind of went through and were able to see that we went through the tutorial of how to do, you know, find the master pattern origination point. And I apologize for those of you that were on and were kind of going through some of that lag with us. So the recording inside of the online classroom is much smoother and you can actually see what I'm pointing to. Anyways, in regards to CAD yen, we formed a new box. We broke away from the previous range, and then we had an expand low, expand high right out of the box. And now we're coming back down to test the most recent expansion line. So if the expand low, expand high kind of continues in its logical progression, then our next move would be an expand low, and we can be looking to maybe even manage risk off of the most recent expansion line, which is basically right down the middle of the range. And then finally, the one that I wanted to spend a little bit more time on is Euro Aussie. So Euro Aussie, very similar to CAD Yen, also started up a new master pattern or origination point. So this pair has been headed short for quite a while. We finally formed a new box, and then out of that box we had an expand high, expand low, and then it formed contraction. So that is technically a origination point. So as of this moment, the market is slowly creeping up. We had a little bit of a run up last night. But we'd be expecting the expand high to take out the previous high around 164,528 if that holds true and stays above the expansion line. Through here, I actually wanted to go through and show you guys something on the hour into the 5, though you can see this on other time frames, but I just kind of wanted to go over this. Give me 1 second. Let me let this catch up. All right, looks like we're good now. So if you look here on the hour chart, you can see that we did have an expand low, expand high. This is in the most recent box on the Euro Aussie 1 hour. We had the expand low and then expand high, and it just kind of took off. At that point, it was fairly obvious that the market was slowly creeping up at that point. We just broke out of the most recent box. So it's, this is very common expansion. But after that, it was pretty clear that we were in a long market. Now, I want to find the beginning of this move on the 5-minute chart. So if you go on your 5-minute chart and compare it to the hour, you can see the market, blue candle after blue, it was just marching up for quite a while. And then on the 5-minute chart, about 3 boxes in, at the very top of the move, we formed a master pattern origination point where we had an expand high and then an expand low. So you can actually see I'm using something called sync cursor where it lines up my cursor on each chart. So the crosshairs are in the same position on my 5-minute chart and my hour chart. So you can see over there on the hour, we are still well into a blue candle. It's fairly obvious that the market was headed long at this point. And then over here on the 5-minute chart, we formed a master pattern origination point. So it expand high, expand low. And that was when it was still clear that things were going long, but that right there let us know that something was awry. And then following that master pattern origination point, we had expand high, expand low, then expand high, and then we came right back down into that overall range from that origination point on the 5-minute. Now I wanted to go through one entry opportunity that came up in this, kind of in line with the master pattern origination point. So again, we started that origination point right basically down the middle of that range on the 5-minute, expand high, and then the market went, and after expand high, we know that the next thing that's going to happen is an expand low. So the market was kicking back and forth around the origination point, and then we went through and had our expand low. Let me actually shrink the chart a little bit so you can see that better. All right, let me let it catch up just in case there's any lag. All right, so we had an expand low that broke through the low of that origination point. Now, after that had happened, price came down and it formed a box. Formed a box down here at the very lows when we know it's an expand low in a primarily long market. So again, we're not trading out of trend or doing anything like that, but there's an expand low in a primarily long market, which means that that's where we want to be looking at getting in to a trade. So below expansion on your entry time frame, above expansion on your higher time frame, and then expand low. So right here we had the market kicking back and forth. It hadn't really taken, or it had just barely taken out the expand low point when it first came down. Then it started whipping back and forth. Then we had one more push down to the short side. It formed a new box. And then out of that box, right before it had the run up, it threw a quick snap down to the short side to take out a liquidity line. So that right there was really key. So you see market makers sucking up some of the liquidity there at the low of that box on an expand low in a long trend. That would be a good time to test the possibility of a trade. Even if you didn't get in on the wick, you see the color change and then manage your risk right around that area. That's a high probability area to get into a trade. Because if this didn't hold and it fell apart, then there was probably a good chance this was just going to keep on heading down to the short side overall. So again, let me let it catch up. It looks like I'm having a little bit of lag again. Really got to get this figured out. So I've got my cursor over that on the 5-minute chart. So that quick little snap down to the short side. Now this, I understand that this is on the 5-minute and the 1 hour, but you can see the exact same thing play out regardless of your time frames, as long as you've got a decent separation between the time frames. But overall long trend, and then on your entry time frame, you track the expand high, expand low, and then once you're in the expand low, there's not a definite price level that it's going to go to, but higher probability area, and then so you have a higher probability area, and then at that point you'll be looking for an entry on the opposite side of the expansion line. So again, that would have been right in this area, right when it took out that liquidity line at the box that was formed at the expand low, and then we can see what happens right after that. Price shoots up to the long side. It basically settled on top of the origination point, and then it kept on pushing to the long side, and then that kind of solidified the expand high. Now I want to flip over to the daily chart real quick just to kind of bring this all home. So on the daily chart, not only do we have all of these candles going up on the hour chart, but then the daily also supports this to a certain extent. Again, we had the master pattern origination point break right out of the daily chart. So expand high and then expand low. And now we're going back into an expand high. Now, what do we do if price comes up, brushes up against the liquidity line, and then starts pulling back pretty aggressively? At that point, we might be able to say that it is reacting, it's pulling back over to the origination point, and we'd be looking for it to expand low again. But at least you are lining up with what at the time is the higher probability place to enter, or the higher probability direction to enter the trade in. So anyways, that basically wraps up that little lesson. I'm going to be going through the comments and trying to hit some of the comments that you guys have about, or any questions regarding this. But anyways, that being said, I'm going to hand it over to Wade. Thank you guys.
All right, thanks, Shane. Yeah, I think that you're still lagging a bit. I don't know if it translates across to everyone's computer, but we definitely need to get that. Seems to only appear when we're on a live webinar, so.
Yeah, for the
Worst
record,
case
before we did this, I did IP config flush DNS, ran through the command prompt, restarted my router, restarted my computer, and I guess Comcast just has it out for me.
So what that translates into is Shane did a bunch of stuff to try to fix it, and it didn't seem to work. Anyway, appreciate you guys being on. Let me kind of get my bearings here. I was going through your guys' questions. You guys are blowing up the chat as usual, so I'm just trying to kind of pick and get a grasp on it here. So we got a number of pairs that we're going to take a look at. We got some questions we're going to go through, and let me get my screen showing here, so we should be good to go. And you guys, if one of you guys can type in a Y, let me know you could actually hear me. That'd be good. All right, perfect. Okay, so screen should be live. And I think we're ready to go. All right, so I'm gonna go ahead and I'm gonna go through some of the questions that we kind of got here, and then I'll get into some of the currencies. So, and I apologize if I'm running a little bit slow today. I went to bed at like 8:30 last night because I tried to get in bed before 10, and I was tired, and I got in bed, and then I literally couldn't sleep. Just was like wheels spinning all night. I was laying there at like 4 a.m. looking at my clock, and I was like, man, this is not good. So anyway, I think I got maybe about 2 hours. So that's how it goes sometimes. So bear with me if I'm a little slow today. Okay, so Eric, I see your questions. You blasted me with like 3 or 4 questions here, so I'm going to try to hit those real quick. I'm not going to spend a whole ton of time, but I want to address them for you. So question 1 is for currency multi-time frame pairing, should I be concerned that the monthly, weekly, and daily do not line up? Should I focus only on the weekly and 4-hour time frame pairing? Should you be concerned? Number one part of the question was, should you be concerned if they're not all in alignment? No, not necessarily. I mean, it depends also on what type of trading you're doing, but looking at the monthly, remember the monthly, the higher the time frame that you're looking at, if you're trading like a 15-minute into a 4-hour, then it's definitely good to know like what the weekly is doing, because it gives you a forecast of what you should expect. Because for instance, if the weekly is clearly trending, say, long, then every time during session when your 4-hour turns long and it sets up on the 15, you're going to think back to, okay, the weekly is setting the pace for the week as it's going to be probably a predominantly long week. So when the 4 hours trending long after a pullback or whatever, you may want to pay more attention to the long side of the market than necessarily the short side of the market. So you definitely want to keep those in mind, but there's not, you want to use the time frames all together to help predict each other. You want to, the time frames is more for you to get a larger grasp on what's probable to happen in the market, as a whole. So there's not, if I guess if what you're asking, and if anyone else has thought that's like, should I not trade until I have 3 time frames all pointing in the same direction, or 4 time frames all pointing in the same direction? Should I not trade, and should I use that as like a set criteria? And the answer to that is, while that can seem like that'll be a safe, padding to a trade and trend, if you're only paying attention to that and you're not paying attention to the overall context of the market and looking at where the lines are at and what the price action is telling you, then what ends up happening is that you kind of overlook important clues, and then you just tend to just get in a trade when things are lining up. It's just, so I guess sometimes sometimes we try to make criteria to take the thought process away. That way we know it's like, oh, that's just when I see those simple things, I could just get in and I'll know it'll be okay. It's not that easy. I don't think that you should always wait to see or to trade just because things are in alignment. I think if 1 or 2 of your time frames are in alignment, that would probably be sufficient. And for instance, let's say like the 4-hour is lining up into the weekly, but it's against the monthly time frame, or that's probably not the best example. Let me think about this. Okay, so let's say you're going to take a 15-minute into a 4-hour, and then you're using the daily to back up the 4-hour for momentum, for a momentum pairing. So let's say you enter on the 15 into the 4-hour going long, but the daily's short. What you'd want to do is that that the daily's short, and let's say the daily's short, but the weekly is long. Okay, here's better. You're entering on the 15 into the 4-hour. You're entering long. The daily is short, but the weekly is still long. What that tells you is you've probably had a day or 2 breath on the weekly trend, and the 4-hour could be the start of the rotation back in trend with the weekly. So one thing that when you're formulating your trading idea and plan, one piece that needs to happen that you need to document is, as far as progress, is the fact that the daily needs to rotate. So you would enter the trade based on standard 15 into the 4-hour criteria, but contingent on hanging in that trade, you would need to see the daily start to come around. and realign in trend. Whereas if you wait 100% for the daily to come around, your entry opportunities may be gone. Because sometimes by the time all time frames are pointing in the same direction, there's no edge anymore. You know, a lot of times it's just it's overextended, long or short by that point, and you know, you're late. So to some degree, you have to find a low. The best thing to do is find, you know, the 15 into the 4 hour. The 4 hour turns going long, and you can see that we've had a 3-day pullback off of the weekly trend, but the weekly trend is still strong. Then, and let's say that's on like a Tuesday or a Wednesday, that you get this 4 hour rotation back in trend with the weekly, and not only are you doing that, but now you're like, you know, 200 pips off the top of the weekly trend. That's a setup for a big rip right there. There's potential going on in pound USD. I'll jump over and kind of illustrate what I'm talking about. Something that I'm babysitting right now, if I could find it. Like I said, I'm slow today. Okay, where's my pound USD? Oh, it's at the top. Okay, so pound USD, and we'll jump over to 1 hour and weekly. Okay, so look, see the weekly, we had this rejection off of the expansion level here, which is definitely a good sign, showing that there's a good chance we're going to continue on the weekly, right? But if you look at the daily short, so this is what I'm talking about. So now this is what could be confusing. But if you go to the hour, you had an expansion right here, and you're way under this expansion level up here, which is your highest expansion level in the weekly trend. So catching a move from up here, you know, there's a big upside just from here down to here to where we're at right now is 91 pips roughly. So we'll call it 100 pips back to the expansion. And if the weekly trend continues, you know, you're talking over 100 pips just to snap the high. So when you see a deviation or a difference in the daily versus the weekly, remember the weekly's still stronger. So if this daily doesn't hold, this thing's coming back blue. It's coming back blue, and it's going through these highs most likely. So, you know, you can measure the initial profit from where you are to where it potentially could go, providing the weekly trends or the weekly trend holds. You know, it's reasonably good opportunity. But if you were waiting for the daily to come in alignment, then, you know, by that time you'll probably be up here, you know, or at the expansion line, and there will probably still be an opportunity up here, which is fine if you're going to do that. But you can, you know, if you can hang in there and deal with a little bit of volatility in the position, because you're trading into the weekly, there could be quite a bit of whipping still that happens. But you can, when you see the daily pulling back against the weekly, but the weekly still holding strong, those are big opportunities if you want to work them. So going back to the question, do you always need multi-time frame confluence, you know, across, you know, 2, 3, 4 time frames before? I don't think so, because then you would miss potential opportunities like this. Like I said, this is, you can see, I mean, it's Tuesday today. And as long as this weekly stays blue, you're pretty much guaranteed you're coming back to here. That's 90, like I said, 90 pips, 100 pips minimum before the trend even continues on the weekly. So something to think about. Anyway, that was that question. Let me see. The second question was if there are conflicting candles by time frame on the same currency, for example, trading the 4 hour pound yen, which has monthly yellow candle below expansion line and the weekly blue candle above expansion. I think this is kind of along the same lines as the first question. So hopefully that question was, or my explanation was answered there. Another question was, you mentioned trading the majors for portfolio based on your system backtesting, their way to filter various currencies for high probability trading. So I guess just generally talking about trading the majors regarding spread, there's no way to really filter things out for the most part. I am actually working on a scanner that may be incorporated into the next ATS assistant that will scan things that are showing good strength. But as of right now, that's kind of where time and experience comes in. You got to kind of just go through pairs, that are in your kind of your watch list, and hopefully it's not a huge watch list, especially if you're new. I always recommend don't trade more than 1 or 2 pairs, especially when you're new. But what really matters is that you're setting up on the expansion phase right on your higher time frame. That's the most important thing. You want to start from the higher time frame and reverse engineer into the entry on the lower time frame. So basically, whether it's your pair or it's one of the pairs you're monitoring, you work from that higher time frame backwards. And if you had the volatility signal, you have a situation like right here on the weekly, you get a clue like that. This is the sweet spot for a huge extended up move. We've already got the whipsaw out of the way. It doesn't have to go, but if it is going to go, there's a big upside. I mean, if this stays blue, very good chance you're going to get to the top of the weekly minimum. That's 258 pips away. And then if you snap that aggressively, you're probably going to go to this level of framework up here. Of course, this is probably going to happen over the course of, I would say probably 3 to 6 weeks, probably, just depending on how fast it goes. But I mean, it's 500 pips. So I mean, it's opportunities you got to work on. So, but anyway, it goes back to your higher time frame. Whatever you're using, that's really where you're gonna find the sweet spot of the trend. And then when you manage it down to your lower time frame on the entry, then you should have something that's tradable as long as you're looking at the higher time frame, right? So that's really what you need to be good at filtering out is sorting through your higher time frames and figuring out which one's ready to go and which one needs more time. And you'll develop that feeling over time. You just look at it and you'll know this thing needs more time, or this thing's getting close, or hey, it's ready to go. So just depends on where it is in the cycle as far as the expansion. Okay, so let me see here. We had a few more questions that came through. Okay, question from David. I've answered this question before, but I'll answer it again because I haven't talked about it in a while. Does ATS have full automation? Was a question from David. And I actually do have a version of ATS Assistant that does fully automate. But here's the problem with that version and the problem with automation in general is that when you're constructing an algorithm for a fully automated system, usually the entries is the easiest part to automate. Everyone can see something that there's potential in an entry opportunity and automation of that criteria. What's not easily figured out is a way to set your stop and limit perfect. So in the full automated version of ATS Assistant, you have to pick a exact stop loss and an exact take profit, and you just let it run based on what you feel like is the best. And the problem is that the market changes cycles, it changes the swing, and what one market situation may call for, say, depending on the time frame, let's call it a 15 pip stop on a 15-minute entry or whatever, a 5-minute entry. That works in one section of market, but as the market changes, the volume changes in the market, different volatility is working out differently according to the architecture, then it may call for a 25 pip stop. It really just depends on the market architecture, and automating that in a dynamic way to get it to actually change in almost like an AI, from like an AI perspective, is extremely difficult. And I always keep it out there. Like I think, how cool would it be just to have something that is plug and play and adapts to all market conditions? But that's one of the things in any automated system, even the ones that are bought and sold, they may show performance good for a long time, but it still is adapted to certain market environments. And even the most sophisticated automated systems can't be fully dynamic typically. I'm maybe on Wall Street they have some black boxes that we don't know about, but from my experience, you even any automation, you're going to have to jump in and change settings at some point. You're going to have to recognize that your stop loss take profits aren't working in the certain market conditions that are happening, and you're going to have to jump in and tweak that. So it's going to take some human intervention, even if it's a successful approach. So anyway, fully automated we don't have yet because of that is the all important thing when developing any kind of automated strategy, is how to make it dynamically adapt to different market conditions, and that is a difficult hill to climb. But we are working on semi-automated, and that's what we have with the signals, and that's the reason I left it at purely a signal. I can have it get you in the trade, and then you set your own stops and limits. But the liability with that, especially with our user base, we have a lot of cool people. Our user base is like, we have amazing traders on board, good guys. But we have a few people that are absolutely just turn out to be nuts. You'd ask Shane because he deals with customer service. And to put some fully automated, strategy or something that gets people in a trade is a huge liability on our part. Even if so, that's one of the reasons that we're going to be careful with that. Just because not everyone would use it correctly. So we leave it at the signals, and that way it keeps your discretion. And it also, you're using your knowledge of the framework of the chart based on your experience, which you can't get around. You got to build the experience one way or another. And that keeps everyone safe and keeps everyone accountable for what they choose to do. And that's kind of where it's at. So, but like I said, maybe in the future, if we crack the dynamic settings changing, then that might be something in the future. But again, very very difficult thing to crack. Okay, we got some more questions coming in here, but I'm going to go ahead and jump. We had a request to look at a few pairs, so I'm going to jump into those, and then we'll probably swing back around to some questions. I'm going to try to keep this webinar around an hour. We usually go over, but like I said, I'm pretty tired today and conserve energy, so I got a lot more stuff I got to get done today still. So first one was Euro USD, so I'm going to jump back over to that. And this was from Bradford, and the time frame looks like was 4 hour into the 15. Okay, so 4 hours trending pretty well. So the only opportunity I see that's really happened at all is you had a quick entry right here below, but it was real fast. I don't know. It looks like it was too fast the way this candle closed, that it actually didn't trigger the expansion until you broke out. So you guys can buy long breakouts if you're feeling really strong about your supporting time frame. You can buy the breakout straight out of the box, but you need to monitor your risk around the expansion line. So if you bought the top of the box right here, and let's say it didn't take off, if it comes back down here, pretty much if you get through the expansion line, you're going to want to cut it and give it a little more room. Because if you do that's that dividing point, and if you get much through the expansion line, you could head back and test the lower architecture. So you got to be prepared for that scenario. But as of right now, the only trade I see in the most recent past was coming up through this run right here and getting up through the top of that box. That's pretty much it. So let me delete the iReg here, so I don't want that confusing everybody. But there may be another opportunity. You'll probably get another dot here soon, and you could enter it. One thing you got to be careful with on this, though, not to say that you can't trade another opportunity, because it very well might. Actually, let me take a look at the weekly. Oops, I'll look it over here. So the weekly could have some gas in it. Actually, it's moving upward. So if we snap the high right here, there's a good chance that you can snap this high, which we do have a liquidity line associated with. So, you know, there might be a decent gap there. You know, maybe, well, it's not huge amount pip wise, but maybe 50 to 100 pips gap by the time you get up through the liquidity lines up here. So it's worth babysitting. But you're definitely going to want to wait for some more architecture on the 15 though. So if it's one of your pairs, I would definitely, you know, keep watching. I would stay to the long side for now, but like I said, the best entry opportunity I think is probably just breaking out of the box, which is a little bit more difficult, a little bit scarier trade to pull, breaking out of the box. But like I said, as long as you monitor your risk around that expansion and don't let it go against you too hard, you know, your downside can typically be from the top of the box down in around the expansion line. What you'd want to do if it did come and test, you'd want it to bounce long off of it to confirm the idea. If it's not bouncing long, good chance you need to just get out of it and give it some more time to give you some more clues. So, okay, let's look at the Aussie dollar. One thing you guys could do too, if you find that you're having a hard time with the 15, you could also trade the 5 into the 4 hour. 5 into the 4 hour will give you more boxes and give you more opportunities to enter the trade. So, you know, 5 into the 4 hour works pretty well too. Okay, so yeah, 15 in the 4 hour. Right now you're just getting up through average price, so you could take a mean reversion trade up through here. This is a more advanced type strategy. If you look at the recent history, we did have expand high, expand low. So it's showing that we're kind of going into that classic expansion pattern, multi-leg expansion. This is a more difficult opportunity right here. As this 4 hour turned long right here, you can see that this 4 hour candle wicked low, which was representative of it had to be this move right here. As it came down and held architecture right here, see how it turned off that expansion level. If you're seeing the overall swing high, swing low, and you're expecting we're going to attack the swing high, then you can take a rotation like this based on the framework and trade that long. But again, this is not the basic strategy. This is something that someone who has been looking at this for probably a year or two would see that, you know, there's a good chance that this is a full rotation and the expectation is it's going to bounce, or once it bounces right here, you'd probably end up buying, you know, up in this neighborhood. No one's going to really get it at the wick. You're going to usually wait for some more confirmation. But if you even got it at the turn, then you monitor your risk down here. And the idea is based on you see the multi-leg expansion happening, and now you're in the trade and you're working it up towards the high, which is right here, which is also the top of the 4 hour multi-leg expansion pattern. That's really all I see right now. As far as the basic strategy, you'd really want to, at this point, we're starting to pierce through the expansion line. You know, I'd wait to see if you get a new box up here and you see the momentum forming, get that counter trend pullback once you're holding above expansion, and then rip it long. That's going to be more in line with the basic strategy. So right now, I don't see anything that falls in that criteria with those basic guidelines. This is the only opportunity I see that happened right here. But again, hopefully you guys get my logic on that, talking through that. It's not as straightforward. But again, with experience and watching this, you guys have the sensitive price levels of where the balancing points are as far as the heavy hitters and the market makers are going to use to balance their books. So how price reacts to that, you know, and the scenarios you come up with on the higher time frame, you can this turns into a possible opportunity based on your expectation of what is transpiring over here. So something to think about there. Okay, let me see. I think there was another pair that was in here. We'll take a look at USD CAD. We'll do some top down on USD. We'll start a little bit higher here. Okay, so monthly short, holding above. See this monthly candle came down, kissed the top of this expansion line right here. So holding that previous architecture. I'll tell you right now, overall, you can see that we're pretty much in a yearly uptrend. We don't have a yearly time frame on this, but you know, the overall, we had an aggressive move upward. Some people may look at this and say this top and this top, oh, it's a double top pattern, and be shorting that. That's one opinion. That may work out according to traditional price patterns. But what I would do, I think the greater opportunity is a lot of people see that as a double top. The better opportunity is holding above right here, getting on your lower time frames, and then ripping the turn on the daily. You know, looking at the daily and the weekly if you're trading the monthly, and I'd catch the next blue monthly candle, you know, somewhere right about here. And then there's 1,000 pips headed up to the high. So, you know, if you're trading over the course of 2-3 months, that'll probably pan out. If it starts to work out on the lower time frames, you'll get the clues, and you rip the trade and ride that up to the high right there, and then see if it snaps, goes up to here. You know, 2,500, 82 pips. You know, not a bad. I know that's a long-term trade. You'd probably be in that trade a year, but that's how some of our traders, they trade long-term and they just want to sit in trades, and that's a potential opportunity there. So, but anyway, it'd be contingent. Basically, your upside is the high right here, and then your downside, I would say, is respecting this level right here. So your stop would be, it'd be probably an average between these two expansion lines. But you can see that we did get a pretty violent reaction off of this expansion level. And when the market respects that framework, then you can give it more weight, because the market's interpreting what you should be paying attention to, you know, especially when you have those reactions. So something to think about, but we are short for the moment. So let's see how the short side of the market's working out. Okay, well, the weekly, if you're looking at the monthly, you know, turning around, I'd say the weekly looks like it's headed for a box, just the way the price action is forming right now. So if you get a box here and you break out long out of that box, if you're trading the monthly trade, I'd just buy the breakout of that box. Because let's say the box forms right here and then you get an expansion basically where price is, I'd buy the top of that box, set your stop below the expansion line, and then ride that thing to the high up here. And then again, that's that same 1,000 pip opportunity. You know, and just by the way the flow looks, you know, I would say it's probably, I don't know, probably like somewhere between 8 and 12 weeks to work up to the top there. Just a kind of a total guesstimate, but you know, there's a good chance that if it breaks out long, you're under the expansion right here. There's a big long-term opportunity that's probably going to play out there. And if it breaks long, gets held up on this expansion, and then comes back, and then gets back to the expansion, then you know that probably that the monthly is going to trend shorter longer, and that this is probably topped out. You'll know that in between that zone that ends up forming right there, should you get a box right here. So I'd just wait for the box before you do anything though. Short term, just based on this weekly, I mean, you guys could see this thing's crawling sideways. I would wait till you start getting some volatility, at least out of this general range. It's gonna be really difficult trading in here. It shows the market's consolidating. Wait for the players to come in. You're probably not going to get much significant trending opportunity. And I bet you when we look at the daily right now, well, the daily's opened up to, it's decent actually, but yeah, it's there's still a lot of choppy days in here, a lot of sideways movement. You know, you're starting to break out of the box. So this could be, when I'm talking about the weekly breaking out past these candles, it'll probably form a box before it does, but as it breaks out through there, you can see that the potentiality of that playing out is starting to hold on the daily candle. See how we broke out, tested average price? So if you bought right here with your stop loss down here, and the weekly holds blue, you already have the blue on the weekly, there's probably a pretty good chance that this is going to at least go to this high right here. And if you snap this high aggressively, then, you know, you're probably going at least to here, you know, which is going to be in line. What price is this? This is 1.40195. What is this? 1.404. So, I mean, you can see it's basically within a few pips, same expansion on the daily and on the weekly, same price target. So again, just scenarios. You got to work out ideas in your head. And then as you get clues that start to prove your idea out, then you'll eventually get enough clues that you want to take action on it. So going down, I don't know if we want to go much lower than this, because this is, you know, I think we've concluded that on the lower time frames, you're probably going to want the daily to open up a little bit, but let's just jump down to the 4 hour into the 15, just take one more look. So 4 hour, same thing on the daily whipped down and held that average price. 4 hour did the same thing. So you can see the time frames are kind of all saying the same thing, which is, it's good. Jump over to the 15. Okay, so 15 is getting rejected off of this line. That's okay. You have a corridor now between this expansion and this expansion. It's probably going to get trapped inside here. What I would do if you're managing a long position, pretty much if you get through here, I'd be done. Because at that point, you're starting to ignore this architecture and you respected this. So that tells you that you're probably going into a prolonged down move. However, if we rotate and you get blue and you get up through here, you know, that actually is not a bad buy opportunity. If you snap this high, basically, let's say the price goes up here, you snap the high, and then it's up here, you can buy it right here and then manage your risk based off holding above. Because this will, if you're talking about support and resistance, you know, I don't like to use those terms. I think they're pretty general sometimes, but let's just say, for instance, you get above here and then now the market uses this expansion line as a so-called support. You know, you can use that to protect yourself and then expect that the market makes progress upward, and you have a nice liquidity line up here. You could aim for a profit that from that level is, you know, it's like 50, 60 pips away. So scenarios just to think about. But other than that, dollar CAD's definitely been crawling sideways. So if that's too technical for you, I'd wait for it to open up, because if the daily does start trending long and that starts to hold, you know, and turns into something significant, there's going to be, you know, you're talking 1,000 pips. There're going to be several good opportunities on the 15 and the 5 minute and probably the hour as well, that you can catch on the way. Remember, if you want to just wait for the markets to trend and show the strength, just try to rip something out of the middle. We don't need to call the turn. You know, just wait for it to line up and just take a little bit out of the middle and wait for another one. Okay,
I
so I
wanted
think
to add one thing to that, Wade. If you look on the 4 hour chart, you can see that it's kind of going through the master pattern. You know, we had the most recent box was a master pattern origination point. So we had expand high, and then expand low, and then expand high, and then it came back down, and we can see the price reacted to the initial expansion line, and now it's creeping back up. So anyways, just something to think about. It's not as important where it is right now, just because it's already ran up, it pushed through the high. So it definitely could continue going long, but you know, if you're paying attention to that, that would have been a good time to test an entry when it kind of settled over that origination point. Yeah, right there.
yeah, that's another thing. Sometimes I'm used to doing it because just kind of glancing over and seeing where we are in the overall cycle, but I try to bake things down to more basic. Remember, the basic strategy, you guys, is something for you guys that have never traded this way. You're new to this way of thinking. It's something. It's to give you the best rules-based criteria that I can give. That'll keep you in line with trading within the master pattern, trading within trend. It's kind of the best thing that I've come up with as far as a safe starting point. But over time, you guys can be a lot more creative with the architecture. That's what ATS is supposed to be, a tool. Like you would use, you know, a Fibonacci or use something else to show you sensitive price levels. You know, it's supposed to be an indicator that you can expand on and use for market insight to form your own ideas. That's ultimately, what I want you guys to use it for. And also, I mean, we all need to pay attention to the trend. If there's a prevailing trend, you really don't want to fight that. But by using the expansion levels, liquidity line levels, and things, you have that market framework that you guys can use to formulate those different trading ideas. And you can take mean reversion trades, you can take counter trend trades, all based on ideas that you formulate, and then clues that you get on the lower time frame that show that those ideas are starting to come to fruition to the point where you want to take action. So again, it's that's we do have some of you guys send in some screenshots, and a lot of you guys do some pretty creative things. Sometimes I learn stuff from you guys. It's like, oh, I didn't see that before. That was a really cool trade, or that's a really good insight. So I appreciate that. But again, the basic strategy is just something, the safest way you're going to engage with Forex or trading in general to begin with is to stay in trend, safe base hits in trend. That's the easiest, safest way to learn trading, and it's good. But obviously the market swings around. There's a ton of opportunity all the time in all markets, but you have to have a lot of advanced insight, and you have to be able to put together advanced trading plans in order to actually do it, where you're not just gambling and just throwing trades out there and seeing what works. You have to work out your risk management. You have to work out what the trade needs to do. How does it need to perform in order for this to be legit? And what do I need to do if it doesn't perform? If you don't have that worked out before you get in, then don't get in. But ATS should give you enough architecture where you can work out more advanced opportunities over time, and you'll have good answers to those questions of what do I do if it works out, and what do I do if it doesn't work out. And so that's what we're trying to give you, is that framework so that you can answer those questions confidently and feel good about it.
Oh, hey Wade, one more point I wanted to add. On the 15-minute chart on the right side of your screen, if you go back 3 boxes, that was another origination point. We had expand low, expand high, expand low, expand high, then a little while later, expand low. Now technically it should be expand high, and that's probably the direction you want to test it, because we've got all of this momentum going to the long side. But if you wanted to test an entry, when you're talking about get in below the expansion line, in trend, that would be, it's kind of our wax on, wax off to get you into the expand high or expand low of the master pattern in trend. So anyways.
Yeah, you could spot that swing high, swing low price expansion pattern is everywhere in every market. So if you always just try to spend a little bit of time seeing if you see that presenting itself to you just in the recent history, that'll give you some insight into where the real predominant lows and highs to pay attention to are. Because again, look at this one coming back up, and then you get this aggressive move down, and then it reverses from there, which may be the actual reverse point. Well, the reason why this one wasn't the ultimate reversal was because this was the expand low point right here. That was the real expand low point of this expansion phase that the market's really reacting to. See 1 leg, 2 legs, 3 legs, 4 legs, 5 legs now. We're on classic expansion from this one area. So again, it's you don't need to totally put all your emphasis on that, but it's good just to glance over the chart and see if you see anything, because sometimes if you don't look at it and then you look back and you're like, wow, it was clear as day and I just didn't consider it. And again, it could just give you just a little bit extra insight when you're formulating, especially the more advanced trading plan. So I'm going to go through and look for a few more questions here, and then we'll probably wrap it up here in a few minutes. Shane, if you want to touch on anything else, go ahead. I'm going to just take a few minutes and keep reading here. So hang on, guys.
Yeah, going back to the 15-minute chart on the right hand side, we can see so we had expand low, expand high, expand low, expand high. And then we had one more snap up through liquidity. This is the second box back right after that. Snap up long through liquidity, And then that's when we shot down into the expand low, and we can see that it also took out more liquidity. So if you want a little bit more accuracy in defining kind of where you should get in and when you should take a look at some of these trades, be on the lookout for chunks of liquidity getting taken out. I mean, that's the whole purpose to the master pattern playing out. It's, you know, so that the market makers and institutions can get a better entry for themselves, and they, you know, they require liquidity to do that. So just be on the lookout for liquidity getting taken out at some of these extended points, and that'll probably, like I said, help your accuracy quite a bit. Or just or in other words, finding the higher probability area to get in, because it can be challenging, like that expand high that pushed to the current prominent high on the 15-minute chart. That was kind of out in the middle of nowhere. There wasn't much to go off of line wise, but then of course we formed a box, then we snapped up long, and we were a little bit more in the range, and we also rotated off of an expansion line at that same time, right in between or right after the second to last box on the 15-minute. So just paying attention to stuff like that, just where liquidity is getting taken out, and watching liquidity change hands in the market is really going to be helpful when trying to identify the higher probability areas. Oh, and almost forgot one more thing. So earlier, while Wade's going through reading some of the notes, earlier was using something called Sync Cursor. I'm getting a few questions just about that. If you want that Sync Cursor, understand it's kind of a freebie indicator floating around. It was actually sent over to me from Vasilis, so a little shout out to Vasilis on that one. If you want that, just shoot a email to support@tradeats.com, and I'll just attach it and send it back over to you. So it just syncs up the cursor between, you know, your 2 charts or 3 charts. Now understand, you're gonna have to install that one on your own. It's not our software, we're not supporting it, so I'll attach it, and then you just have to add it into your data folder if you know how to do that. So and then one more little housekeeping note that I wanted to make. We had mentioned that we were going to be going through and making a little bit more official stuff regarding the master pattern. We're trying to screen questions for it. If you want a little bit more insight on that, I'd encourage you to send over a good screenshot of your screen. So please, no cell phone pictures for this particular thing, but send over a good screenshot of your screen, like your entry time frame or higher time frame or whatever you want, and we can go through and kind of work with you on identifying the origination point, or talking about why it's not really working out, or, you know, whatever it is. But, you know, I'd encourage you, again, take a good screenshot, maybe even make your chart really wide so you've only got one chart up, and then you take a turn at identifying it, and then we'll reply back, and we can kind of start a discussion about identifying the origination point on a chart. So anyways, again, just take that and send it over to support@tradeats.com.
Yeah, that's one thing I want to let you guys know. We're more than happy to help you guys work through the thought process of trades. But we do need, sometimes we get screenshots. I don't know if it's a technological problem with some people, but we literally get the worst picture ever from, like, someone's taking a picture of the screen on their cell phone and say, what's happening with this chart? And honestly, guys, we cannot do anything with that. We need you guys. We have a screenshot tutorial in the online course. We need a clean screenshot, you know, preferably that's marked up with your entry and your exit on the. You could use Paint to be able to do that. Again, we have a tutorial to take screenshots, all that in the classroom. But we're more than happy to give you guys feedback and think through the thought process when you're thinking about entering a trade, or you're thinking about, am I looking at this market right? Again, it's you guys that need to pull the trigger. So disclaimer, you know, you guys, we're not taking liabilities, but we're more than happy to give you some insight if you want it. You don't need to. If we confuse you, then just do your own thing. But you know, we're more than happy to look at those as they come in. But make sure, if it's a picture on a cell phone, I'm telling you right now, we're going to email you back, say we need a screenshot. We're not going to do anything with those. You need to learn to take a screenshot. If you know, it's really important, not just for engaging with us, but just important for technology's sake and being able to work on stuff. So Okay, so let me see. I had a couple more questions that came in here. Okay, here was so a question. I've talked about this before, but the same question. I'll answer it again real quick. What would be good time frames for direction entry if I wanted to hold a trade for a couple of days, not scalping and not holding for weeks? So a good thing for that, if you're looking to be in a trade for a couple of days, uh, probably your best bet for that would be the hour into the weekly. If you're trading the hour into the weekly, though, I would recommend trading 1/3 to 1/5 your normal position, because you have to be really, really good typically to nail the entry on the hour. And you're probably most times not going to get it perfect, and there will be an opportunity for you to layer in more trades into the trend at a better price. So hour into the weekly is good for that. 4 hour into the weekly is also pretty good, but you're going to get less opportunities. The hour will get, since it's just you get more candles per week, will give you more boxes, more architecture. It's a little faster, but yeah, I tend to prefer the hour into the weekly. And then as you're betting on the weekly trend, you can back the weekly up with the monthly. So when the weekly lines up with the monthly and you get a nice setup on the hour, those are very high probability trades, and they usually have upsides of, minimum 50 plus pips just coming to your first progress point, which is usually the top, top or bottom expansion in trend. So that's just my recommendation. Again, you guys do whatever you want. But if you're looking, building a position in the weekly using the 1 hour chart is a pretty low stress way to trade, providing you're not over leveraged. If you're over leveraged, and have risking, 15-20% on an entry, yeah, you can make a lot of money, pulling 50, 100 pips at a high leverage, but you don't want to get blown out of the game, and you need to give those trades a little bit of room to breathe. You got to give them some room to form so you can make decisions. So again, either use low leverage or plan on breaking your position down into like 3 to 5 different positions of your normal, so that you can layer, and you can even layer them in if the trade goes against you, but you still feel it's good. Put another position in. As long as your higher time frame is intact. If your higher time frame turns against you, then it's time to go. I'm not telling you to layer into a bad trade. It's not what I'm doing. That's one of the cardinal sins of trading, is layering into a bad position. As long as your trend is still intact and it hasn't totally reversed on you, you can build the position at a better price. And then as the trade goes in your favor, you can add another position to it. The idea is to be able to give it more time and avoid, what you're ultimately trying to do is avoid a major reversal. Like let's say on a grade A opportunity, those ones are usually going to work out immediately or they reverse immediately. That's the whole point of the grade A. You're either early or it's nothing early, which is good too. So if you trade the grade A, say the 1 hour into the weekly, you put your first trade in at 1/5 the position. If the weekly is in a trend, you're going to have multiple opportunities to put the rest of your position size in. Don't think that you're going to get the perfect entry and I should have went all in on that one entry. Let it go in your favor 30 pips and then put in your next position. But if it goes back against you, put in another position. As long as it's still good and it's obeying the general criteria that you set out for the trading opportunity, give it some time, because you're going to learn more information. So anyway, just something to think about on that. I'm going to see if there's one more question here, and then we'll probably wrap it up. So I think Eric's asking, should you use the target placement at expansion lines or liquidity lines? You could use both. Depends on what you're doing. Expansion lines are going to be those tipping points of the market. Those are the most important lines on the screen. But if you're talking about booking heavy profits in trend, you want to use the liquidity lines. Are good to give you projected targets. Because they also paint forward as well. They give you more real-time indications, because you're not seeing expansion lines from way back then. So liquidity lines are going to give you more relative price targets in trend. But expansion lines, if you want to use those if you're just generally trying to navigate a range in trend, The expansion lines are going to be more important for that in the initial range. But as you break out, as you're up 50, 100 pips, depending on the time frames you're trading, you want to use those liquidity lines, and then also use the expansion index as well. Remember, if you're trading and you're trading long on the opportunity, for instance, if you're long in this opportunity, you can see it's going back. It's just holding in this corridor right here. It's trying to figure out where it's going to break. But right now, you gotta beat this blue right here. You got a little bit of blue, but really the one to beat is this one right here. So as this thing starts going, if you don't beat this one right here, you got to think about what you're going to do. You got to start making some decisions, and you got to, so as that's growing, if you beat this one, then you got to look, shoot for these liquidity lines up here. So you have multiple things to give you those indications of when it's time to, time to get out and when it's time to let it run. And that's really what it's all about. So, all right, guys, thank you so much for being on. Really appreciate your guys' participation. We will plan on seeing you guys next week, Tuesday at 10 a.m. And until then, everyone stay safe and make good trades. Be smart. Don't over leverage. Number one thing. If you guys learn anything from us, it's stay in trend. Don't over leverage. Because if you're out of the game because you blew it all on one position, then you can't trade anymore, and you won't be around for the perfect opportunities. So, wait around, wait for the opportunities that really make sense to you, that you understand. No one else. I don't need to understand it. Other people don't. You need to understand it, and you need to have a clear trading plan for that. Trade it with a good size leverage. Use good risk management. Stay in the game, and then you'll succeed. All right, guys. Thank you so much, and we'll catch you guys next week. Thank you.